Guys, welcome back. As we discussed yesterday's video, we are going to see ESOP problem, which is employee stock option problem, and with the concept what they are trying to make us understand with this problem. That's what we are going to. This is one of the crucial problems in this area, so I've brought this for our keen understanding. So okay, let's get into this problem. Okay, what they're saying: K limited. Okay, K limited granted options. Okay, options for equity shares. Actually equity shares has been given for options at the option price of rupees 80, and the market price is rupees 170. So the intrinsic value is the value which has to be covered by the company. So this is the cost. From the stakeholder point of view, they are going to get as from the employee perspective, they are going to get as a gain, and from the company perspective, this will be a expense. Okay, so 80 minus 70, 170 minus 80, which is 90. So 90 is the intrinsic value. Okay, and what else? Vesting period. So usually when the company is issuing employee stock option plan, they'll fix a timeline. Like if the employee enters into the organization, he has to stay with the company for at least 3 years or 4 years or whatever the timeline fixed by the company. So this is the vesting period to get eligible for the ESOP, which is employee stock option plan. Once he reaches the 3 years or 4 years, he'll get the ESOP options at subsidized prices. Like here we are getting at rupees 80, no. And for the once the vesting period gets over, he go through the period of exercise period, which is he can exercise the options and he can buy the stock options at the lesser price from the market price. Okay, this is the exercise period. Okay, vesting period is what we have known, that the employee has to work with the organization for the specific period. If any employees have been left the organization, then those ESOPs will be unvested. Okay, unvested in the sense those ESOP will be no, initially the company will take a conservatism concept, and they'll preserve some values for those employees. No, though if the ESOP has been unvested, those amounts will be transferred to general reserve. Okay, that's what. Okay, and I hope you guys have understood this ESOP concept. Okay, let's get into the question. Okay. Okay. Okay, what they are saying is 110 17. This is the time the company has been granted option. Okay, option at rupees 80. Okay, and the market price is rupees 170, intrinsic price is rupees 90, difference price. Okay, so these are all the informations we need to know at the initial stages. And then the company has kept a vesting period of 4.5 years. Okay, once the vesting period, okay, if 110 17 is the option granted period, then 131st 3 18, 31st 3 19, 31st 3/20, 31st 3/21, 0.5, 1 year, 1 year, 1 year, and 1 year. This is 31st 3/22. Okay. Okay. Uh, this is the vesting period, and the company has fixed a 4.5 years of vesting period. So the vesting period gets over by 31/3/2022. Okay, and the some options has been lapsed on 1/12/2021. 1/12/2021 is so prior to the exercise price itself, the exercise period itself, the some employees have been left, some employees have left the organization. Okay, options unvested is 8,000 shares. Okay, and then during the exercise period, on 30/9/2022, 6,000 options are exercised. Okay, and 2,000 options have been lapsed due to non-exercising. Okay, so initially the company has granted 16,000 shares of options, and at the time of 21st December 2021 December, 8,000 shares have been unvested due to the employees, some employees of the organization. And then on 30/9/2022, 6,000 options were exercised by the employees. Okay, as we have delivered to the employees, they have exercised it during the exercise period, and the 2,000 options were lapsed due to non-exercising. So with this concept, we are going to get into the problem. So let's build the working note. This working note will be the base for the entire journal entries, comes under this um, ESOP journal entries. Okay. Okay, this intrinsic value is no. This intrinsic value is the ESOP expenses for the company. Okay, so how many periods were there? This is 17 to 18.5 years, 18 to 19, 19 to 20, 20 to 21, 21 to 22. Okay, 0.5 years, 1 year, 1 year, 1 year, and 1 year. Okay, so okay, options were granted 16,000 shares, 16,000 shares, 16,000 shares, 16,000 shares. And during 2021, it was came to know that the company, the employees have been left the organization, which is amounted to 8,000 shares has been invested. Okay, so 8,000 shares only remaining. Okay, into intrinsic price into 90. Okay, 16,000 into 90, which is 14 lakh. 40,000 is the entire expense going to face by the company out of this 16,000 shares. Okay, for every year, we are putting this exam, we are putting this value because okay, every year we are just plugging the figures here, but we are going to show expenses only for the 0.5 years, in the 4 out of 4.5 years, and 1 year out of 4.5 years, and 1 year out of 4.5 years, and 1 year out of 4.5 years. Okay, and 8,000 into 90. At the time of 2021 to 2022, we came to know that only 7,20,000 rupees of employee ESOP expenses only the company is going to face. So at the time, what will be our approach is going to we'll see shortly. Okay, 14 lakh 40,000 into 0.5 into 4.5, which is just 1 lakh 60,000 is the amount we are going to put it under outstanding, okay, liability. In year 1. Okay, what about year 2? 14 lakh 40,000 into 1 divisible by 4.5, which is 3 lakh 20,000. Okay, this 3 lakh 20,000 is nothing but this is the split of this 14 lakh 40,000. Okay, and but at the year last we came to know that only 8,000 shares are going to get by the employees. So 8,000 shares has been unvested due to the employee left. So at that time while we calculate that, we came to know that only the ESOP expenses for the company is comes around 7 lakh 20,000 alone. Okay, so but so far we have already put it under ESOP outstanding is rupees 1 lakh 60,000, 3 lakh 20,000, 3 lakh 20,000, 3 lakh 20,000, which is rupees 11 lakh 20,000. This is the amount we have already credited to ESOP outstanding account. Okay, so but we only need 7 lakh 20,000, right? When we deduct this amount with the already transferred balance of rupees 11 lakh 20,000, we get rupees 4 lakh in excess. This excess amount has been transferred to general reserve. Okay, right. So this is the simple table which we with this we are going to prepare the journal entries in the books of K Limited. Okay, what is our first entry? We are facing 1,60,000 as ESOP expenses in the year 1. ESOP expenses account, debit to ESOP outstanding account. We are setting aside some amount which is going to occur in future. So okay, so we are periodically split the entire amount into year, and we are setting aside the amount of that discount, that is the intrinsic value amount for the future period. Okay, this is 1,60,000 and this is 1,60,000. Okay, let's debit it to P&L account. P&L account debit to ESOP expenses account, which is 1,60,000, 1,60,000, and this is on 31/3/18, 31/3/18. Okay, right? See, okay, for 18 to 19 the amount is 3,20,000. 31/3/19 ESOP expenses account, debit to ESOP outstanding account, 3,20,000, 3,20,000. Okay, 31/3/19 we have to return off to P&L account to ESOP account, ESOP expenses account, right? Sorry, here also ESOP expenses account. So 3,20,000, 3,20,000. This is the same entry for 31/3/20, 31/3/21. Okay, same entry we are going to put it for the subsequent years. And during the December 2021 we came to know that only 8,000 shares are going to be optioned, because 8,000 shares has been invested, right? Okay, So for that unvested shares, we are transferring the excess amount to the general reserve account. Okay, 31/3. So on 31/3/2022, we don't need to further charge the amount to the ESOP outstanding, because we have excess amount, because we have rupees 11,20,000 rupees. See, this 11,20,000 rupees we have uh, uh, in our ESOP outstanding account. Okay, so we are transferring this excess to P&L account, sorry, GR account, general reserve account. So ESOP outstanding account debit to P&L account, we have transferred the 4 lakh rupees. Okay, at last on 31/9/2022, 6,000 options has been exercised. Okay, for the 6,000 options, we are going to receive bank account debit rupees 6,000 into 80. This is the option price fixed by the company, and the ESOP outstanding account. This is the provision we created for ESOP expenses that going to occur in future. So this, the future has came, so we are going to use that balance. This is 90, right? 2, equity share capital account, which is 6,000 into face value rupees 10, to securities premium account, which is 6,000 into 160. So let's total it up. 6,000 into 80, 4,80,000, 90, 5,40,000, 10, which is 60,000, 160, which is 9,60,000. So we have issued the share capital at the premium price of 160. Okay, and what about the balance 2,000 options which is lapsed, right? So for the 2,000 options, what we did for the 8,000 shops, 8,000 shares has been unvested. So we are going to do the same here. Okay, on 31/9/2022, ESOP expenses, sorry, ESOP outstanding account debit to GR account. Okay, how much we have left in our balance? So we had 7,20,000 minus ESOP balance used is 4 lakh 5,40,000, which is 1,80,000. Okay, that's it. The sum is over. So this is only simple problem. We are provisioning some amount for the future expense that we are going to incur for the options exercised by stock options exercised by the employees. So 16,000 we initially offered at the price of rupees 80. Market price was rupees 170. We found the intrinsic value is rupees 90. So we created the timeline for the timeline. 4.5 years is the vesting period, and 4.5 is the vesting period, and 1 year is the not 1 year, that's I think 39/2022 is the last period. As per question, they have not given it clearly, so we assume that 39/2022 is the lapsing time. Okay, lapsing time of exercising period. So at this period, the entire options has been lapsed. Okay, on 21 December, 8,000 shares has been unvested, and only 6,000 shares has been exercised, and 2,000 shares lapsed due to uh, over the exercise time. Okay, so statement of ESOP expenses we have created to set aside some amount in the outstanding account, so that we can use it in future when when the ESOP expenses actually arises, right? So options uh, granted for the uh, granted for the granted is 16,000 shares on 21/22, 8,000 share invested. So while we calculate this, we came to know that ESOP expenses we are going to incur in future is 14 lakh 40, 14 lakh 40,000. So we have splitted this 14 lakh 40,000 by the year wise, and at the 21/22 we came to know that 8,000 shares has been invested. So the amount we need in outstanding balance is 7 lakh 20,000. So we are going to only apportion this 7 lakh 20,000 to our account. So but we have already set aside rupees 11 lakh 20,000 in our outstanding account priorly. So now we only need 7 lakh 20,000 in our account. So we have transferred the 4 lakh which we have already shared into our account to the general reserve account. So for the outstanding creation, for the liability creation, we use the entry which is ESOP expenses account debit. This is expenses, this is liability. So we increased both the things. And P&L transfer, we have we are transferred into P&L account. So this is the entry for all the 4 years, and then we have transferred the excess balance to the general reserve account, and then we have issued the share capital to the employees for rupees 80,000 at the intrinsic value of rupees 90, and the excess options which has been lapsed, right, that has been transferred to GR account. So that's it. We'll see some other new concept tomorrow. Thanks.